I'm always looking for a quality compounder to add to my £63,000 plus stocks and shares ISA on Trading 212, where I invest in individual stocks. And Visa matches this description very well. As a capital light monopoly, that is a 7% position in this portfolio. However, today I think I've found one that could do very well in the long term as a compounder as well, just like Visa. It's now down around 30% in the last 3 months, and I believe this one could be offering great value and good shareholder appreciation. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So today I want to talk to you about a stock that is a quality compounder in my opinion in the financial area, in mainly the payment processing and payment point of sales industry. They're a banking solutions provider, and they are an excellent one for the future potentially because they're now down very much. And this is, of course, Fiserv. Now, Fiserv is an excellent business that is now down about 31% in the last 3 months and around about 21% in the past year to date. But if we look at it over the longer term, in the past 5 years, they've actually returned around 270%. So this is one is very good at executing, but is now down in its luck after it reported its Q1 2025 earnings. Having looked through their earnings report, I wasn't too concerned. There was a few things to point out from this earnings report. The first thing was that they had GAAP revenue growth of 5% and an organic revenue growth of around 7%, which missed estimates slightly. I think it missed by around about 500 million, which is a substantial amount, but essentially it's not really something that is working towards my thesis with this stock and the value it presents. The thing that was actually very good to see, in my opinion, was that the company reaffirmed its 2025 guidance, organic revenue growth rate outlook of around 10 to 12%, which is a re-acceleration from the 7% we have seen anyway. So they're expecting to grow more than what they've grown in this quarter. And their adjusted EPS outlook has stayed the same, growth of about 15 to 17% at around $10 or so. And this is something that is very good because at the moment this company and business is trading for around forward EPS of 16 to 17 times, which is really low for this growth rate of 15 to 17%. However, even though their EPS did beat only slightly and their revenue missed slightly, their overall free cash flow fell considerably, around 18% year over year to 371 million. Now, the management have provided a reason. They've basically said that increases in investments in technology and client projects. Now, how much you believe this and the management team is something that you'd have to decide for yourself. It came across as very fair that this has happened, but obviously it doesn't necessarily allay everyone's concerns. Now, I think the main thing to remember with this business is that it can be slightly complicated. There's lots of different moving parts to this business and 3 different business segments that we need to focus in on. The first being merchant solutions, which is their fastest growing sort of business segment, mainly because of Clover. Now, this is their main segment. Organic growth around 10% in small businesses and 8% overall. And we see that it's only really done about 10 basis points year over year, mainly due to adjusted operating margins coming down considerably between Q4 and Q1 of 2025. And we're now seeing an adjusted revenue of around 2.3 compared to around 2.4, 2.5 that we were seeing previously. So obviously not good, the acceleration over quarter, even though Q2 is generally the lowest for them overall. And if we look at what Clover is, what they do, essentially a tap and point of sales payment processing solution. They're the big card machine that you'll see at restaurants, at different retailers. And essentially you probably tap your card on them repeatedly day after day and never really know you're using them. They're a point of sales between that and the bank, and essentially they offer that to their clients as a way of best providing a sort of tap and go solution. And this is expected to grow in around about 27% to 28% CAGR over the next 3 to 4 years. It was growing around 30% previously and has deaccelerated slightly, I would argue negligibly. And so we're sort of seeing this one slow down slightly, but the revenue growth is a big driver for this business and the big source of revenue growth and organic revenue growth for this business. It's also worth noticing that in the banking solutions segment, essentially they have a very high retention rate and they are the biggest player. So we have their US core market share here. This is an industry that's growing very slowly, only around 6%, so we need to bear that in mind. But we are seeing that Fiserv are the best and biggest player. They're operating at a 40% market share compared to competitors like FIS Global, which is sitting at around 18% and below that. So essentially competitors are not really moving in on this Fiserv. And we can see that in this industry as well, Fiserv have about 99% retention rate of their clients for banking solutions. So they're not really losing any clients and they are the biggest player. Then we have their financial solutions side of the business. This is showing good growth, even if it is a little bit slow. This includes their banking segment, and it's growing around about 6% organically. So we are seeing good, consistent growth, but it is very slow on the top line for this business. So it's worth noting they're number 2 in merchant acquirer. This is behind JP Morgan and is quite a big thing for Fiserv. This industry is growing quite well for them, around 13%, and is their second fastest growing segment behind Clover. And they bought the likes of Data Corp in 2019, and this was one of their acquisitions. This was actually quite a big deal because it was $22 billion, and Fiserv was a smaller company out of the two. So it's quite strange, and that is why their earnings calls and stuff like that focus on organic growth, because they have other sort of services like the likes of Data Corp, which are separate to their actual sort of organic growth. And in this particular way, we can see that this business is actually growing itself through acquisitions as well as organic growth in the form of Clover. Now, to see how the fundamentals have improved over time, we can see that their revenue growth has slowed down more recently in the past 3 years, offering a CAGR of about 8%. And this is likely to continue to be the case around an 8%, so below a 10% growth rate in overall revenue, but consistently growing in their top line to $20.7 billion now in the trailing 12 months from March 2025. And then we've got the likes of their free cash flow, which is also growing very consistently, and it has a 21% CAGR over the past 3 years to $5.1 billion in the trailing 12 months since December 2024. We can't see the free cash flow numbers for 2025 yet, but it will be a slightly lower, around this sort of $5 billion mark here. And this is all feeding into what I like to see with Fiserv, which is their buybacks. So we're seeing free cash flow and top line revenue growth is fairly slow by consideration towards maybe bigger players. But Fiserv do amazing buybacks, very similar to Booking Holdings. They've consistently had a CAGR over the past 5 years of around 5% growth, sort of buybacks. And that has sort of increased over time as their share count decreases. So I would like to see them in this particular dip we're seeing now continue to buy back shares at an accelerated rate to overall compound the growth rate of earnings per share and value for shareholders. Moving on to probably one of the biggest risks, I believe, with this company that I should really point out, and is a point of conjecture for me in investing in this company. And that is rising competition from new players and expectations around the user experience. So obviously Clover is the main driver for their revenue. And we have the likes of Adyen and Stripe, key competitors in the fintech businesses that are starting to try and erode their dominance in this industry. And we're not really seeing that in the financials yet, but it is a point of concern as a form of a shareholder in Fiserv. So we've got here some fintech disruptors are marketing their solutions directly to the consumers or retailers and entering the market to meet their banking needs in new and unique ways, which is pressuring financial institutions to transform their business model. And if we look at Adyen's processing volume, essentially how they're growing a lot faster than Fiserv. So I see this as a point of concern. They're growing over 40%, while Fiserv is a lot lower than that. And right now, their business segment in North America is growing at a 29% CAGR over the past, say, 3 to 4 years. So whilst Adyen isn't the only player in this game, I think there's lots of competitors. And even though the switching costs give Fiserv a good moat, this does cause me quite a bit of concern. Now, if we look towards what we're willing to pay for this business, currently Fiserv trade for a price to earnings of 27 times and a price to free cash flow of around 18 times. This is historically very low for the business. We have an average over the past 10 years even, on price to earnings front of around 39 times compared to 27 now. And an average over the past 10 years for price to free cash flow of 24 to 25 times compared to the price to free cash flow of 18 times. Obviously, in the past, this business has been valued quite a bit higher, mainly due to higher rates in growth, but it is worth noting that they are massively undervalued compared to their historical averages. Additionally to that, we have a price to earnings in forward estimates of around 16 to 17 times because we're expecting such high EPS growth for 2025 and onwards. So I do think this is one that's offering good value compared to its historical metrics. Moving along to estimated revenue and EPS growth for analysts for this business. We can see that they expect on the revenue estimate growth rate to sit around about 8% to 9% in 2026 and 2027, before falling off to around 6% to 7% in 2008 and 2009. This is an overall revenue growth rate of around 7 to 8%, which is what I would expect for this business as well, and what I'd sort of factor in. EPS, on the other hand, shows very good growth. We see that the EPS is expected to grow around 16 to 16% in 2026 to 2027 and 15% in 2008 onwards. So I would like to see that this sit around 16% growth rate, and I see that happening with the likes of Fiserv. Now we can use a DCF using those EPS growth rates to come to a conclusion about what the fair value of this business might be. So we've got net earnings here, so we're going to do an EPS growth rate initially, and then we'll do free cash flow. We'll look at a 5-year time horizon and say they will grow their EPS at around the same value that they've given us, around 15%, which is what analysts expect. And then we say that the share count is obviously remaining 0 because we're doing EPS and not earnings on its own. We do a price ratio of 29 times, which is what they currently trade at now. So if they just hold their own value, they have no price to earnings multiple increases, and they just match what they're currently valued at, then we get a CAGR of around 16% over the next 5 years and a fair value of $212 per share, which is signalling undervaluation. Look towards their free cash flow. We allow for metric growth rate of around 13%, below their 5-year average of 15%, and it's actually sat closer to about 20% in the past 3 years. So actually, this is very conservative indeed. We've got a shares outstanding reduction rate of about -4%. Owing to the fact that they've actually bought back closer to about 5% in the past 3 years, we could make this higher. And a price ratio of 18 times price to free cash flow, which is what they currently sit at. This allows for no margin expansion, just maintaining at the same level and well below the 5-year average of 22 or 23 times. Then we get a CAGR around about 17.5% over the next 5 years and a fair value of $226 per share. So whatever way we look at it, with EPS and free cash flow, I see lots of upside with this stock and very little downside. The stock price now sits at $162 per share, and the growth rate we've sort of seen over the CAGR for the next 5 years sit between 16 to 18%. So very good upside for this stock. The reason I've stayed out of it so far, and the reason I'm still on the sidelines now and considering what to do next, is because I'm concerned that the competitors may gain ground against Fiserv, and I'm trying to delve deeper into that to see what their moat is looking like and whether this is a business that can survive longer term. This may be a good turnaround play because Q1 earnings has actually looked quite bad, but the future looks very bright for this business. But what do you guys think? Let me know down below. And as always, thanks for watching, and I'll catch you in the next one.